The gold and silver prices could go up much higher. Negative interest rates, the volatility in the stock market, the rising debt. This is very good for the gold and silver prices. It was doing exactly what it was supposed to do.
Please join us for our next live stream, September the 1st at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be September 1st, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, if you are new to this channel or you have not already done so, please do subscribe. Click on the bell to be notified on new updates and do give us a thumbs up. If you like what we do, we appreciate your support. Today we have a returning guest who was also our first guest we ever interviewed on SBTV. He is Steve St Angelo, author of the very popular and insightful website SRSRocco Report. Steve also has a YouTube channel with the same name as his website, so please do visit and support his channel as well. Good day, Steve, and welcome back again to SBTV. How are you doing, my friend?
Doing great, Patrick. We've had some interesting things going on in the market, so there's plenty to discuss.
Yeah, absolutely. Too many to keep a handle on sometimes. But let's start by going into gold. It's had a great run since August of 2018, and we're talking about, I believe, a 30% rise in prices since then. And you've written at large about the high correlation between the price of oil and how it correlates with gold. And for our listeners who are not familiar with this correlation between oil and gold, can you explain the significance?
Yes, and I believe there's certain analysts that are calling for Harry Dent for much lower gold prices, 700, and he's got a realistic price of 450, and he's using the bubble start back in 2004. Well, you see, if you just look at charts, you know that there's a possibility, right? But when you realize that the energy price has increased so much, and the gold mining industry, the ore grades are falling, the production cost for the industry back in 2004 was $400 an ounce. Well, I just looked at Barrick and Newmont, and now it takes them about $1,200. That's their total cost. It takes about $1,200 to produce an ounce of gold. So if we would see lower oil prices like 700, some of these analysts are saying, then I would say you'd have to see a 50% destruction in the global gold mining industry, because they're producing gold at like 1.2 grams per ton. And so, yes, in the 1970s, Patrick, when the oil price shot up from $1.80 a barrel in 1970, it went up to $36 a barrel in 1980. Well, guess what? The gold price went from $40 to $612. That was the average. That wasn't the high for the year, but that was the average annual price. So some analysts say, well, gold was in a bubble. No, it wasn't. It was doing exactly what it was supposed to do. It was to protect investors' wealth from inflation. So when oil price, which is the leading driver of the economy, everything stems from oil, the whole economy. And so when the gold price shot up, so did the price to produce gold. And so we saw the same thing in the 2000s when gold shot up to 1,000 and then 1,900. And so, yes, I do believe the oil price has been an indicator for the gold price, but guess what? Going forward, we could see a big disconnect. The gold and silver prices could go up much higher, but the oil price could actually fall.
Oh, okay. Yeah, that was going to be my next question. Where if you think the rise in gold prices last year was solely due to rising oil prices, but you're seeing there may be a disconnect coming forward.
Yeah, and I wrote about this, that when gold shot above its major resistance level of 1360, and that's held for 6 years, since 2013. When it broke above it, it went up to 1440 consolidated, and then it went up to 1520 very quickly. But over these last month or so, the oil price has been kind of trending lower. So it has nothing to do with the oil price right now. What it has to do is with these huge increase of global negative yielding debt. And so I do believe the oil price can, in a recession, and I think we're starting to see more of a global recession indicators. When things start to slow, demand slows for energy, oil prices could continue to fall. But due to all these other indicators, or all these other dynamics in the market, which we could talk about, but it's very good for gold and silver. Negative interest rates, the volatility in the stock market, the rising debt. This is very good for the gold and silver prices.
Yeah, okay. I think we've been the people who have bought gold and silver, we've been enjoying it, and other people they're looking to get on that train before it really leaves the station. But I think correct me if I'm wrong. I think at one point you said that you used to more or less disregard technical analysis, but now you've found it to contain clues where the price will head in the future. Can you share with us what changed your mind about technical analysis?
Well, there's the idea that the precious metals are being manipulated, and I do agree to that to a certain extent. But what's happened over the past 30, 40 years, the Federal Reserve and the governments have kind of funneled people into three markets: the stock market, the bond market, and the real estate market. And that's 99% of investors have their money in those assets and businesses. And less than 1% have them in gold and silver. And so that's really, that was the trick, was to make sure everybody continued to put their assets in those three different sectors. But I never really looked at technical analysis, but if you go back and keep an open mind and look in the last 40-year chart of gold and silver, you're going to see that when they broke out at these key technical levels. There's no coincidence. And so what happens is there's this momentum, and this is what I found out in the day trading markets. When a stock or commodity goes above a certain key level, then it's on the radar of investors, traders, hedge funds, and institutions. So there's like a big punch that comes in, and there's a lot more volume, and the price starts to move up. And that's exactly what we saw in gold, and that's exactly what we started to see in silver when they broke above their 50-month moving averages. And so now I do believe the paper buyers have been the leading drivers of price, not the physical buyers. They'll come in later. So yes, I do believe technical analysis, which has been the, let's say, the formations and the technical levels, have provided the breakouts for gold and silver over the past 10, 12 years. They're going to do that in the future, so we should pay attention to that.
Okay, yeah, so fair to say your analysis is showing that gold and silver are primed for some pretty big moves in the months ahead.
Yeah, and for example, I use the silver ETF as a guide, and what's interesting, the volume on the silver ETF has really increased. In 2016, when the silver price shot up from 14 to 21, the volume on the silver ETF, the most it reached in 1 month, and that was in July, was about 300 million shares. Well, last month in July, when the silver price started shooting up in the silver ETF, 400 million shares were traded. And then already this month in August, we had 306 million shares traded as of the end of last week, and there's still 2 weeks left in the month. So when you start seeing more volume, it means that there's more interest. And I do believe because of the negative interest rates. Trump just came out. He wants to see Powell cut 100 basis points and start QE. This starts to put fear in the investors. And so I think we're starting to see that in the volume. So yes, I do believe this is very good for the precious metals moving forward. Maybe we could see a correction because they're kind of overbought on the short term. Nothing goes up in a straight line, but over towards the fall and over the next couple of years, I do believe we're going to see much higher gold and silver prices. Okay.
Yeah, I completely agree with you there. 1%, I think that may be a bit too much considering we only have two and a quarter even or less. But well, anyway, when the price of gold rallied at the end of May, it quickly got to levels last seen 6 years ago, and mainstream news quickly highlighted that gold was at 6-year highs, but the move in silver was slower and somewhat delayed, and now it's at levels close to the start of 2018. In your opinion, Steve, what do you think would be the reason for silver to have that slow start compared to gold?
Well, as you know, gold has hit all-time highs now in 73 different currencies. And I do believe it's going to take a little bit longer in the US dollar because the Fed has the monopoly on the printing press. But silver lags gold, and it takes a little bit more time, and silver has been so depressed. But again, it's finally broken above its 50-month moving average. It's been below that since 2013. And so gold broke out first in June above its 6-year resistance level of 1360. And when it broke above it, it went to 1440 like in 3 days. Now, silver, it started to break out of its 50-month moving average in July, the next month, and it did even better. But you know what? If we go back to June, the beginning of June, right when gold was taking off, from I think it was $1,310 when it started trading in June. In the last 3 months, gold went up to 18%. Silver went up 20%. So in the last 3 months, silver has outperformed gold, even though in dollar terms it doesn't look as impressive. But I like to talk. I don't know if we're going to talk about the COT, but I've seen some very interesting positive news about silver in the COT report compared to. Well, in the last 2 weeks, the silver price has gone up. At the end of the COT reporting time, it's actually gone up about 45 cents. The commercials have liquidated almost 19,000 short contracts. 22% of the commercial net short position on the COMEX has been liquidated. And the price has actually gone up. Even though we've seen some volatility, there's a little bit of a correction in the beginning of August, but almost 19,000 net short positions. The gold is still almost at their high of their net short positions compared to silver. And what is even more interesting, Patrick, in this last week, when silver closed at 1645 at the beginning of the COT reporting cycle, it's gone up 3% in that last week, and 10,000 contracts, commercial short contracts, were liquidated. So I do believe my analysis suggests as the silver fundamentals continue to increase, I don't believe we're going to see, as the silver price goes up higher, we're not going to see higher and more larger commercial net short positions. I think they're going to consolidate. We may see the commercials liquidating and having a shorter short position as the silver price increases. So it's a different dynamic. Silver is looking better than gold right now.
Okay, I think that's news to a lot of people. Usually you don't COT reports. Usually you just see all the net shorts, everybody piling in on the net shorts.
Correct.
So, yeah. Okay, so this is a bit different now. It's good to know. But Steve, given that gold and silver prices have risen for nearly 3 months, are you expecting a pullback to happen soon? I mean, if prices are heading higher and they don't move up in a straight line, right, as we just talked about.
Yes, and if you look at the monthly chart of silver, when it broke through that 1360, went up to 1440, corrected, and it's interesting. There's this ascending triangle formation. That's exactly what gold did all in July. It continued to correct, but as it corrected, it moved up and up closer to this to that 1440 level, and then. Right in the beginning of August, it shot right through it. And in 3 days, it went to 1520, 1525. Well, you know what? 1525 is if you look at that monthly chart, it's the next resistance level. And I've got that in my other video I did on the gold and silver market. So yes, I do believe now at 1525, we could see a correction. And I wouldn't rule out that the gold price could go all the way down to 1360 because that's what it did in 2009. In 2009, when gold shot up, it shot up, it went to like 1,200. Do you know it came all the way down over the next 3 months, back down to like I think it was 1,020 before it started to go up to 1,900. So I'm not saying it's going to do that, but it shouldn't be negative, taken as negative, if gold has a correction, because that's what it will do, as well as silver. Silver could correct back down to 1620, or to me, the low would be 1550. Those would be two levels that we would see it would base before moving higher. But you never know with the insanity now in the markets. We might not see that. But if it does happen, Patrick, it's not a negative sign. It's a healthy correction in an ongoing bullish trend.
Yeah, I think that's part of it, where guys, they've been kind of wait and see. They want to see what the consolidation, the corrections before they jump back in. But with the ratio, we saw it at about 85, then we've seen it move up to about 93. It's about 88 right now. You think this ratio is going to come back down to? Do you have a certain target number in your mind that you see the ratio going down to or up to?
Well, I looked at a long-term gold-silver ratio chart, and when you look at it, it peaked right at it. It went a little bit above that 95 to 1 ratio. The thing is, I think earlier on it went up to 105 to 1 briefly, and that was a spike up to 105 to 1. Could it continue higher? It could. But if you look at the way the market is changing now, and the way silver is looking better on the COT report than gold, I don't think we're going to see this gold-silver ratio head back up to 100 to 1. It could go back up a little bit higher, but I do believe the silver-gold ratio will start to decline. And when we start seeing much more, let's say, friction, much more volatility in the currency markets, in the stock markets, especially more negative interest rates, and there's some interesting information coming out about that, then I do believe the gold-silver ratio will fall, and I do believe that it will fall back to that 65 to 1 level. That's the medium. The medium is 65 to 1. The top is about 95 to 1, and the low is about 30 to 1. And guess what? I did a chart on this. The two times that the gold-silver ratio hit their lows of 30 to 1, it was when the unemployment rate in the U.S. was at a high. And you would think that doesn't make sense, right? Because, industry, there's less demand for silver. No, but I believe it was in 1983 and also in 2011. And in 2011, the unemployment rate in the U.S. was 9.2%. And in 1983, it was 10.4% unemployment. So again, silver could do well during when there's high unemployment.
Okay, so if we saw you walking into the bullion shop, gold and silver shop, what are you walking out with? Gold or silver, or both perhaps?
Well, there's this, if you trade or go by the gold-silver ratio, you tend to buy silver when it's over the 70 or 75 to 1 ratio. And then you start to buy gold when it's the 60 or 40 or 50, between 40 and 65 or 70 to 1, then you could buy more gold. So right now, even though, you could buy a lot of silver and you got to store that silver, right now, we look at these things on a short-term basis, but when you look over these cycles, right now is the time to buy more silver than to buy gold. And I know several large precious metal analysts, that's what they also recommend.
Okay. Yeah, I know it's so tempting to buy gold, and a lot of times we overlook the silver, but I think the ratio is sometimes a pretty good indicator. But moving forward, thanks for your opinion with that. Appreciate it. But moving forward, we often discuss prices in nominal terms without considering the inflation and the adjusted price of gold and silver today compared to decades ago. An example would be back in 2011, in the peak of silver prices, was less than 50% of its peak in 1980. In today's dollars, the 1980 peak was more like $117 an ounce. Do you agree that the Fed's meddling in the economy has caused so much inflation that it masks the true price of assets and signals needed for the market to make decisions, and it's basically all messed up right now?
I agree, but that's a great question, but there's a complicated answer. And I believe the valuation right now, the way the markets are valuing silver and gold, if you estimate, and I believe that the price to produce gold is $1,150 to $1,200 an ounce, and actually it's about $15 to produce silver, primary. I'm not talking base metal, but primary. Well, you divide those two, and you get 75, 80 to 1. Well, that's kind of way the algos, I believe, are treating gold and silver. They're just treating it as a commodity. And yes, the primary mining industry, give or take, produces silver now at about $15 an ounce. Now you go back to 2002 or 3, it was $5. So this idea that silver is going to go back down to 10 or 5 is just as insane as thinking that the gold price is going to go down to 700. Because of the energy as well as the ore grades. The ore grades in the primary mining industry are down 50% in the last 15 years. So now these miners have to move twice as much ore to produce the same silver. This all goes into the dynamic. So even though on an inflation-adjusted price, silver today is a lot less than it was in 1980, this is kind of how the market is pricing currently the value of gold and silver. But we have to understand that's all based on the energy. And when you realize that 99% of the assets that the investors are invested in, stocks, bonds, and real estate, those to me are going to be in big trouble. And so, unfortunately, investors don't know that yet. So all you need is 1% of the global investors to move into precious metals, and you would see much higher prices, even much higher on an inflation-adjusted price.
Steve, in your opinion, do you think gold and silver guys, do you think we really understand the concept of energy and how it relates to gold and silver?
No, we don't. And a lot of people think I'm a precious metal analyst. We discussed this in the pre-interview. I'm a precious metal guy. I'm not. Or they'll say I'm an energy analyst. I'm not. I'm an analyst. And then I've come to learn, as my research has grown, I've come to learn that energy is the number one factor that drives the entire economy. If you don't know what's going on in energy, then you're missing the major factor. Doesn't matter about the debt. Doesn't matter about the interest rates, because you have to remember, you turn the switch on, the light comes on. You don't even think about it. You put gasoline in your car to drive to work. You don't even think about it. It's become, we've taken energy for granted. So my energy analysis suggests we're going to be in big trouble with energy. And the three assets, stocks, bonds, and real estate, I call them energy IOUs. You need a growing energy supply to continue to give those value. If you don't have that, then their asset values are going to collapse. On the other hand, gold and silver are stores of this economic energy. And so if you own a gold or silver coin, it is a store. It's not an IOU. And so this is the new kind of analysis going forward. Most investors don't understand that. And so that's why I believe, unfortunately, the precious metal people don't look at the energy, and they should, because the energy is going to be the factor that drives precious metal prices as the store of value. They will protect wealth, and this is the new paradigm we're heading to, Patrick. Investors need to transition from building wealth, because we're not going to have the energy to do that. And we're starting to see that now, to protecting wealth. You can't protect wealth in stocks because, as we saw in December, the Dow Jones fell off a cliff. The worst Christmas Eve traded day on the Dow Jones in its history, and it's only been propped up by central bank intervention. Central banks can print money, lower interest rates, but they can't print barrels of oil. That's the real issue. So this is the problem going forward, and I'm going to be writing a lot more about that.
I have to admit, I don't follow energy too much, but I do understand that there is a relationship between the two that should be looked at. And you even mentioned central banks, and I think lately former Fed Chairman Alan Greenspan, he came out recently saying that there's no barrier for U.S. Treasury yields to go below zero. Do you think we're going to see these negative rates in the U.S. once the Fed is pretty much, once they have their back against the wall with zero interest rates?
Patrick, I think investors are going to be shocked how low interest rates are going to go below zero. If they thought 2 or 3, 0.2 or 0.3 or 0.4% was a lot, I think we're going to see 5-6% negative interest rates. And I've got an article coming out about that. Because if you're at zero right now, like you are in Germany, and you hit a recession, well, what's the motto? You got to lower 500. You got to lower 500 basis points. Well, if you lower 500 basis points, where are you? You're at a negative 5% interest rate. And so, will the Fed? Is the Fed going to stay in positive interest rate environment if everybody else is heading to even more negative? No, they're going to jump along. And so this idea that gold doesn't pay a yield, that's why you shouldn't be in gold or silver. Well, that whole notion gets destroyed if you've got 100 million and you own a U.S. Treasury or a German bond, and they want 2 or 3% of that money, of that 100 million. The whole idea now is going to change. Then the precious metals become not losing money. It is better than having a negative yield. So I do think we're going to see much lower negative interest rates from the central banks going forward.
Yeah, you touched on Germany, where the 30-year German bond went sub-zero for the first time ever. But Steve, how in the world did we ever get to this point where investors are basically going to be paying the government to take their money?
Well, it all comes back to the energy. Because of this falling energy return on investment of oil in the United States, we were producing 100 barrels of oil for the cost of one. I'm not talking price, I'm talking energy cost in the 1930s. It fell to 30 to 1 in 1970, and shale, it's 5 to 1. Well, our society needs, according to Charles Hall, we need about 12 to 1 to run everything correctly, this advanced economy of ours. Well, shale isn't paying the bills, and this is starting to happen now in a lot of major different economies. So how do you offset that? You increase the debt. Unfortunately, as debt goes up, well, so does your finance cost, your interest cost, your interest expense. So as the debt goes up, you've got to drop the interest rates. And here's another thing. When you look at energy and the energy that makes it to the market, even though there's so many millions of barrels of oil, it's the quality of that oil, the net energy, and that's declining. So if you don't have the profitable energy, you can't have positive interest rates. And so it's actually the energy, Patrick, that's forcing the central banks to lower interest rates. And now we're getting into negative interest rates. And let me conclude by saying this is similar to what happened to the ancient Roman Empire. The ancient Roman Empire collapsed due to its falling energy return on investment. And towards the end of its empire, do you know what it did? It went after the wealthy. Because the wealthy had gold, it had riches. That's where the easy, higher to get stored economic energy, or EROI, was located. And so we're seeing the same thing now. That's why we're seeing negative interest rates. It's all due to the energy.
That's a very interesting way to look at it, Steve. Never seen it that way. Steve, I want people to know more about your work. How can our listeners know more about SRSRocco Report and, of course, your YouTube channel? Because what you're saying right now, I think a lot of us haven't connected the dots yet.
Yeah, and I think when people connect the dots, you don't trade gold and silver. You buy and hold it. If you've got a lot of money and you want to trade, that's fine. But you should be buying and holding physical gold and silver. Now, I've got my SRSRoccoReport.com website. I try to put out 2 to 3 articles a week. And to explain some of these more complex issues, I have my SRSRocco Report YouTube channel where I talk about technical analysis now with the precious metals, but I talk about energy and how energy and the falling energy return on investment is going to impact the future assets or the assets in the future. And there's certain assets you don't want to be in, and there's certain assets like gold and silver that will protect wealth. So that's where they can find my work.
Okay, I for one going to head straight there right after this. So I want to know what's going on. But Steve, again, absolutely appreciate you coming on the show. I don't know if you know this, but again, you were actually the first one that ever came on the program. So we appreciate you always giving us the time that you do. And we'll be sure to direct people to your website and your YouTube channel, which is pretty darn good.
Well, I'm glad to be able to chat with you, Patrick. And I think anybody out there that's trying to provide investors with a way to protect their wealth going forward in gold and silver. And they're not the only ones, but, you know, they've been around for 2,000 plus years. So why recreate the wheel? You know, they protect wealth and they'll do an even better job going forward.
Okay. Steve St Angelo, SRSRocco Report.com. We hope to get in touch with you again and have you on one more time. But you take care, my friend, and we'll see you again.
Thank you very much. It's been a pleasure.
That was Steve St Angelo of the SRSRocco Report. For more of his insights on the precious metals and global economy, please visit his website, www.srsroccoreport.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.